June 27th, 2016, we had the Brexit last Friday, and a lot of drastic moves have occurred across markets since then. If you go to the stage analysis screener and you filter to indexes, which is a good way to get a general health gauge across markets on this page, and if you look at the list of foreign market ETFs, you can see that only 6.3% of these ETFs are still in stage 2 now, and 75% are in stage 4. So a lot of damage has occurred in a lot of the major developed foreign markets and pushed these ETFs back into stage 4. The FTSE has taken a lot of damage as well, and as of today, only 36% of stocks are in stage 2 versus 47% in stage 4. The NASDAQ has also taken some damage, and again, we have more stocks in stage 4 now than stage 2. So these markets are looking weak now again, and are actually looking more like bear markets once again. Now, looking at U.S. markets, the transports and the triple Q are in stage 4 according to the screener now. So even in U.S. markets, we can see that two of the major indexes are in stage 4 now. And in U.S. sectors, the financials are in stage 4, and consumer discretionary is in stage 3, along with the technology ETF XLK. So some major sectors in the U.S. markets have weakened considerably as well. And what I want to talk about next is the financials. And really, this is a bad sign for the U.S. markets because you typically never see a bull market in U.S. equities without a bull market in financials. So financials have been underperforming the S&P 500 since the middle of 2015 and have continued to do so since then. And we can see a lower highs ever since the middle of 2015 as well. And it looks like XLF might be breaking into a stage 4 decline again. And notice that the first two stage 4 declines were negated pretty quickly, but once again we're back below the 30-week moving average, and it's declining. And looking at the FAZ ETF, full disclosure, I am long this ETF, and it's taking big volume, which is a good sign for the bear side of the market, because you see big volume come into these inverse ETFs when the market is ready to go down kind of in a more sustainable way. Usually I check these inverse ETFs to kind of provide a gauge as to whether big money is going into these ETFs in a down move, or if it's just a small correction. A lot of times you don't see big volume come into these ETFs, so it's a good sign to see real big volume coming into this ETF if you're a bear. And notice how it broke above the 30-week moving average today, and the volume this week is going to be big because the volume today was already almost 6 million shares, and average volume is just over 6 million shares for the week. So by the end of this week, we should see this ETF potentially have a larger volume candle than it did, or bar than it did the previous 2 weeks, which is a good sign for an overall stage 2 breakout in this bear ETF for the financials. Now looking at the triple Q, again, this ETF has really been topping for 2 years now, and once again it's below the 30-week moving average, which is flattened out, which is typically what you see in a stage 3 topping phase, and it's been underperforming the S&P 500 all during this year. So this is another bad sign for the bulls, because technology is pretty much the growth sector of the economy, and when it's underperforming the S&P 500, it typically means the economy and markets are in a contraction phase. Now turning to gold, gold's really just performing fine here. It had a stage 2 breakout earlier in the year and did a retest at the end of May and bounced off the 30-week moving average on huge volume. Again, I'd like to see a little bit more volume in the ETF, but this wasn't bad, and the GLD has been outperforming the S&P 500 all throughout the year. So gold is still in a confirmed stage 2 bull market and has been rallying for 5 weeks now. So we could see a pullback maybe this week, but overall still in a stage 2 bull market. Gold versus foreign currencies actually broke out from a consolidation that's been in place since February. So this is pretty bullish for gold, not only priced in US dollars, but priced across all other foreign currencies, to see gold continuing its stage 2 breakout. And notice how it retested the moving average here and then broke out once again. So another confirmation of gold stage 2 bull market across all currencies. And gold versus British pounds, obviously the British pound got hammered on Friday and again today, and gold versus this currency completed the stage 2 retest once again, and then with the huge currency moves in the last couple weeks has really dramatically moved higher. And silver is continuing to perform like gold. It broke up into a stage 2 a little bit later than gold, retested, and then broke out again on pretty good volume, almost 2 times average volume a couple weeks ago, and we're waiting for a confirmed move in the SLV above 17 now, but silver isn't overbought at all and is still in a confirmed stage 2 bull market. Now the US dollar is actually potentially in a bullish situation now, considering the fact that a lot of major foreign currencies are now moving back into stage 4, and since the dollar is weighted against them, it could push the dollar potentially back into a stage 2 bull move. And notice that the US dollar did break above the 30-week moving average this week, and volume last week wasn't too bad, but volume this week is already at almost 5 million shares versus 8 million shares on average. So if we see the US dollar complete a breakout this week on high volume, which could get as high as maybe like 20 million shares this week if it keeps going, that would put a bullish posture into the US dollar and make it possible that this kind of a correction consolidation since the parabolic move into March of last year could be over, and the dollar could be moving on into another bullish phase before it completes this bull market. Now, what we want to see in the market, in the S&P 500 overall, is at least 60% of stocks typically above the 200-day moving average to really have a sustainable bull market. And that would kind of coincide with the stage analysis screener, where we want to see, at least 50 to 60% of stocks in stage 2 for a bull market. And notice like what happened in 2008 is that once the market topped, we didn't see 60% of stocks in above the 200-day moving average until the bear market was over in 2009. So every time we've had major corrections in stocks, we see the percentage of stocks dip below 60%, but they always retake that number when they get back into a uptrending market again. And what we've seen since the middle of 2015 is that the percentage of stocks has remained below 60% above the 200-day moving average for the most part until the last rally, the last couple months. It actually got above it again, but now we're back below it again. So once again, we're in a position where the market could break into a stage 4, given the fact that less stocks are holding the market up to keep it from going lower. And once again, I like to look at these inverse ETFs to get a general gauge on whether the bears are serious about the bear side of the market, or whether the market is just experiencing a small correction. And notice that on the SDS inverse ETF of the S&P 500, which is one of the biggest inverse ETFs in the market, the volume on this ETF was 45 million shares on Friday and another 35 million today. And this is the same type of volume that we saw in the August meltdown in the market, and actually bigger than the volume that we saw in the meltdown in the beginning of the year. So this is pretty solid volume for the bears, and if this continues, we're going to get another stage 2 breakout in this ETF, and which could be a signal of a confirmed bear market. So overall, the S&P 500 has been in this trading range for a couple years now, and once again we're breaking below the 30-week moving average. We've done that twice in the last year, in August and early this year, but both of these bear moves were quickly negated and the market moved back higher. And whether this is going to happen again or not remains to be seen. But we do have the financials underperforming and the technology sector underperforming, which is a bad sign overall for the stock market, and which suggests that it's possible that a real bear market move could take place, instead of these fake moves that have been kind of just chopping around and making trend following a hard thing to do over the last 2 years or couple years, which is why it's refreshing to have a market like gold breaking into a new stage 2 bull market versus the choppiness in the overall market indexes.